Picture this. You're sitting at your desk watching a live feed of a massive multi-million-dollar rocket booster just completely fail to ignite. Alarms trigger, the whole mission gets aborted, and literally millions of dollars in market value evaporate in an instant.
And then you open a new browser tab and see a Wall Street bank posting a $20 billion quarter, which is partly fueled by the fees they collected, taking that exact same rocket company public.
It is some serious whiplash. Welcome to Financial Candy. We've got a massive stack of sources in front of us today for this Friday, July 17th, 2026 edition. We're looking at SEC filings, options flow data, demographic research from Cerulli and Visa, and some pretty wild agricultural commodity reports.
The mission here is really just translating Wall Street's biggest moves into the actual human incentives driving them, looking past the headline numbers to see how the market mechanics actually function.
So we're unpacking the real math behind the so-called great wealth transfer and figuring out how a simple packaging change quietly saved the global olive oil market. But starting with that divergence we just mentioned, the SpaceX IPO hangover is a perfect example of this.
The contrast between the institutions building the market infrastructure and the individual retail investors placing bets on the outcomes has rarely been this stark.
I mean, SpaceX had this blockbuster market debut, right? Hitting an intraday high of over $225. But since joining the NASDAQ 100, gravity has fully taken over. On Friday, shares dropped to $122.12.
That is a 44% plunge from its recent high. It's now sitting roughly 9% below its actual $135 IPO price, extending a 10-day slide.
The immediate catalyst for that slide is firmly rooted in physical engineering. On Thursday, the Starship V3 test flight had to be aborted.
The issue wasn't engine ignition failure. Some of the Raptor engines simply didn't start, which immediately triggered an automatic launch abort. So the propellant gets offloaded, and the physical reality of aerospace testing collides head-on with public markets.
Because a delay in a concrete physical launch translates instantaneously into financial volatility. And that volatility absolutely ran over retail investors this week.
The options data shows a massive flood of everyday traders buying short-dated, out-of-the-money call options, basically betting the stock would just keep going up.
For anyone unfamiliar, buying a call option is essentially buying a lottery ticket that gives you the right to buy the stock at a higher price later. If the stock drops, that premium you paid goes to zero, you lose everything. So now the market is flooded with the opposite side of the trade puts.
A put option being a bet that the stock will go down. It's like buying a parachute.
But I was digging into the options flow data, and there's a fascinating nuance hidden in the volume. Over half of those put premiums were not bought. They were actually sold by institutional traders.
The mechanism of selling a put is where you really see sophisticated capital stepping in to absorb the panic. When you buy a put, you pay a premium for safety. But when you sell a put, you're the one collecting that premium.
Let's break down the mechanics of this with an analogy, because selling a put flips the risk dynamic entirely. Instead of thinking about it like fire insurance, think about it like being paid to wait in line for a house you already want to buy.
If you sell a SpaceX put at a $135 strike price, you're collecting cash today. If the stock stays above $135, you just keep the cash and walk away.
And if the stock crashes below $135, you're obligated to buy those shares at $135. But for a massive institutional trader, they likely view $135 as a steep discount anyway. They're getting paid a premium to set a limit order on a stock they want to own long term.
The options flow data shows exactly this kind of calculated risk management. One institutional trader bought $2.6 million worth of 140 strike puts for protection, but simultaneously sold the same number of 175 strike puts against it.
Capping their downside risk and drastically lowering the cost of the trade. Everyday retail traders often expose themselves to maximum risk by just buying directional bets without a hedge, whereas the professionals structure their trades to generate yield even when a rocket fails to launch.
Speaking of professional insulation, that brings us back to Goldman Sachs. They were the lead underwriter for that massive SpaceX IPO.
While retail traders are nursing massive losses on those call options right now, the underwriters are entirely insulated from the post-IPO share price drop. Goldman reported a complete blowout for their second quarter earlier this week. We're talking revenue up 39.5% to $20.34 billion.
Their earnings per share surged 92%. They collect the massive advisory fees, they thrive on the market volatility, and they walk away. The financial infrastructure always wins.
Following the flow of capital from that financial infrastructure takes us directly to the physical infrastructure. Because Goldman advises the tech giants, but Taiwan's Semiconductor Manufacturing Company, or TSMC, is the entity physically etching the silicon that makes this whole artificial intelligence boom possible.
TSMC's second quarter numbers are just staggering. Profit jumped 77.4% year over year. They're earmarking an additional $100 billion investment just for Arizona, bringing their total commitment in that single state to $265 billion.
For context, they're building advanced packaging fabs. These are literal hyper-sterile factories where silicon wafers are printed at atomic scales. The demand for these AI chips is so intense that they simply can't build the physical factories fast enough.
Market analysts pointed out a massive structural anomaly in how TSMC is operating right now, though. They possess a near-total monopoly on the most advanced 2-nanometer and 3-nanometer chips. NVIDIA and Apple literally cannot go anywhere else for this hardware.
Which begs a huge analytical question. If you are TSMC and you're the only game in town for the most critical hardware on the planet, why aren't you price gouging your customers to the absolute maximum? Economic theory dictates that a monopoly should squeeze every available cent of margin out of its buyers.
The mechanism at play is deliberate strategic restraint. If TSMC exercises its full pricing power and doubles the cost of a silicon wafer, NVIDIA has to pass that cost down, doubling the cost of their GPUs.
Then the cloud providers double the cost of computing time. And suddenly, the end user, the thousands of AI startups trying to build new applications, can no longer afford the computing power. They go bankrupt. Demand collapses.
TSMC is choosing selective, minor price increases to maintain their own margins, while ensuring their customers stay highly profitable. They're basically farming the AI ecosystem for long-term yield, rather than mining it for short-term extraction.
That constraint on the cost of computing power introduces a whole new front in the AI hardware race. Because it's no longer just about raw processing speed, it's about energy efficiency and the cost to run the models. Meta is reportedly in talks to hire longtime Amazon Web Services executive Dave Brown.
Dave Brown specializes in a metric called price performance. The transition from raw power to price performance is really the most critical shift in the tech sector right now.
General-purpose computer chips are designed to handle thousands of different types of tasks, which means they waste a massive amount of electricity routing data through pathways they might never even use.
Brown's expertise is in custom silicon. The mechanism involves stripping out all of those general-purpose pathways and designing a chip that only knows how to do one highly specific type of AI math.
By stripping out the versatility, you drastically lower the electricity required to run the chip and the water required to cool the servers. If Meta wants to build out their own cloud computing business and lease power to AI companies, they need the computing equivalent of a hyper-efficient hybrid engine, not a gas-guzzling muscle car.
The talent war is now focused entirely on efficiency. Before we track where the wealth generated by this corporate infrastructure actually ends up, this is a good moment to mention that you can find more of this kind of market analysis along with our sister show Brain Candy and a full library of classic audiobooks over at clarinhoratia.com.
The hundreds of billions of dollars being poured into AI infrastructure represents corporate wealth accumulation on a historic scale. But the ultimate constraint on the broader economy isn't how fast a corporate server runs. It's how much money everyday human beings actually have in their checking accounts.
Which brings us to the macroeconomic data regarding personal inheritance, which has been pushing a specific narrative for years, known as the Great Wealth Transfer.
The discrepancy in the data here is wild. Cerulli Associates has heavily publicized an estimate that $105 trillion is going to pass from older generations to their heirs by 2048. It paints a picture of this massive economic golden age for millennials and Gen X.
But a new study from Visa, analyzing the wealth passing from baby boomers over the next 20 years, estimates the number at only $36 trillion.
Losing over $60 trillion between two spreadsheets requires us to look at the underlying math. The distance comes down to the mechanism of what is actually being measured. Cerulli is looking at total aggregate assets across all generations.
That massive $105 trillion number is highly relevant to wealth managers because they earn percentage fees on total assets under management, regardless of whether that asset is a liquid stock portfolio, an illiquid mega mansion, or like a massive art collection.
Visa approaches the data from the perspective of a payments network. They only care about liquid cash that everyday heirs will actually have available to spend at retail registers.
To find that number, Visa strips out the top 1% of the ultra-wealthy. Billionaires don't stimulate the broader consumer economy when they inherit money. They buy private equity or hold assets in trusts.
Visa also subtracts the debt held by boomers, the estate taxes, and, crucially, the cost of end-of-life healthcare. That healthcare metric is the most brutal reality check on this data. Boomers are living longer, and the out-of-pocket costs for memory care or a prolonged hospital stay can easily wipe out a middle-class inheritance in a matter of months.
Think of the total wealth transfer not as a gross salary versus net pay, but as a massive water reservoir. The $105 trillion is the water sitting in the lake.
But by the time that water flows through the dam, evaporating through taxes, being diverted for healthcare, and siphoned off to pay down mortgages, the actual stream that makes it to the crops of the consumer economy is tiny. Visa estimates that only $8 trillion will actually hit the real economy for everyday spending on cars, travel, and homes.
Even a heavily reduced $8 trillion injection is going to impact markets, particularly real estate. The June data highlights a housing market that is already buckling under systemic pressure.
Housing affordability has slid for the fifth consecutive month, with the median home price sitting just over $446,000 and an average mortgage rate of 6.57%. A buyer now needs a verifiable income of $109,152 just to qualify for the loan.
The median individual income in the United States does not even come close to supporting that requirement. The federal government is attempting to intervene in the mechanics of this specific market, though.
The bipartisan 21st Century Road to Housing Act actually became law just last week on July 11th. It specifically targets the supply side of the affordability equation by placing severe restrictions on large institutional investors producing single-family homes.
The legislative goal is to freeze deep-pocketed private equity firms out of the residential market, theoretically freeing up inventory for the very heirs who are about to receive their portion of that $8 trillion wealth transfer.
The policy is a direct intervention into supply and demand dynamics. By removing institutional buyers who can make all cash offers over the asking price, the market mechanism should favor the everyday home buyer.
However, housing requires physical construction. Restricting buyers changes the bidding war, but it doesn't instantly build the millions of new homes required to offset decades of underbuilding.
The structural questions surrounding this wealth transfer also extend to the tax code, because if the everyday economy is only going to see $8 trillion, we have to look at where the rest of the money resides.
The top 1% holds an estimated $28 trillion of boomer wealth alone. State governments, facing their own budget shortfalls, are aggressively looking at mechanisms to capture revenue from that ultra-rich demographic.
California voters are heading to the polls this November to decide on a highly contentious ballot proposal, a one-time 5% wealth tax on net worth over $1 billion. The stated policy goal is to generate massive new revenue streams to fund state healthcare initiatives and offset federal funding cuts.
Analyzing the incentive structures here requires absolute impartiality. State governments have legitimate, pressing social funding needs. But the asset base they are attempting to tax is highly mobile.
We're not talking about taxing income as it's earned. We're talking about taxing unrealized net worth. Assessing the value of a private tech startup, deciding it's worth $1 billion, and demanding 5% of that value in cash creates massive liquidity problems for the founders.
We have concrete recent data on how human behavior reacts to this specific policy mechanism. Norway has maintained a wealth tax for years, but half a decade ago they sharply increased the rate.
The center-right think tank Civita tracked the economic fallout from that. They found that more wealthy Norwegians abandoned the country in 2022 and 2023 than in the entire period between 2014 and 2021 combined.
That represents a 518% increase in wealthy individuals packing up and leaving. When they leave, they take their capital, their consumption, and decades of future income tax revenue with them. It is textbook capital flight.
The counter-argument, and it's a strong one, is that California possesses network effects that Norway does not. Despite possessing the highest cost of living and a notoriously complex regulatory environment, California consistently ranks at the absolute top for technology, innovation, and access to venture capital.
It's the ultimate global innovation cluster. The universities, the talent pool, the sheer density of engineering knowledge, these things have immense financial value.
So the behavioral economics question becomes, at what specific percentage does the financial cost of taxation outweigh the network benefits of living in Silicon Valley? Google co-founder Sergey Brin has already moved his primary residence to Nevada, specifically to avoid the risk of this wealth tax.
The proposed tax is not a marginal 1% fee. It's a 5% hit on total net worth. payable in installments that carry a 7.5% deferral charge. Opponents point out that the pandemic proved that high-level executive work and capital allocation can happen remotely.
You do not need to physically sit in a San Francisco office to wire funding to a startup. The results of this upcoming November ballot measure will serve as a live-fire behavioral economics case study for every other state treasury in the country.
We have tracked capital flow from immovable real estate to the highly mobile flight of billionaires. For our final segment today, we're looking at an everyday consumer staple on your kitchen counter that has experienced its own extreme market volatility.
The global olive oil supply. Between 2022 and 2024, the olive oil market experienced a catastrophic supply shock. Severe, prolonged droughts and unprecedented heat waves across southern Europe just decimated the agricultural yields.
The crisis is definitively over, though. Favorable rainfall patterns have finally returned to Spain, and the wholesale price of extra virgin olive oil has plummeted to roughly $4.47 per kilogram.
That is a massive, stabilizing drop from the record highs the market suffered in January 2024. So the macroeconomic supply chain is healing. But the most fascinating element of the story has nothing to do with Spanish rainfall.
DLEO, the parent company behind massive brands like Bertolli and the world's largest olive oil company, engineered a massive boost in their U.S. retail sales by completely bypassing agricultural metrics and focusing entirely on consumer friction.
They relied on the ketchupification of olive oil. I find the mechanics of this so brilliantly simple. DLEO released data showing that 40% of the entire category's growth in the United States was driven by a single packaging innovation.
They stopped putting premium extra virgin olive oil exclusively in heavy glass bottles with tiny spouts, and they started putting it into functional plastic squeeze bottles.
After surviving global climate shocks, severe water scarcity, and international supply chain chaos, the secret weapon to unlocking the American consumer wallet was simply giving you a bottle that is easier to squeeze over a salad.
It is the ultimate proof that you can model the most complex agricultural commodity supply chain in the world. Factor in tariffs and currency fluctuations. But if the end user finds the physical act of pouring the glass bottle annoying, your sales velocity will stall.
Removing a 3-second friction point changed the entire growth trajectory of a global brand. We've spent this entire session analyzing institutional options trading, semiconductor pricing leverage, and the taxation of unrealized billionaire wealth, and the final boss of the global economy turns out to be a plastic squeeze bottle.
The through line connecting all of this data is human behavioral adaptation. TSMC is carefully restraining its pricing power because it understands the behavior of its customers. Visa redefined the entire wealth transfer by studying how humans actually spend money on healthcare versus consumer goods.
And DLEO drove growth by removing the physical friction of a glass bottle. The new, lingering question this raises is how long it will take for these intersecting trends to combine.
If human friction is this easily manipulated by a squeeze bottle, how long until the advanced AI hardware being built by Meta and TSMC isn't just analyzing supply chains, but is actively designing physical packaging and digital interfaces perfectly calibrated to exploit our behavioral quirks?
The collision of hyper-advanced computing and simple human friction is going to be fascinating to watch. That's financial candy for Friday. We'll be back on Monday. If you need something to listen to over the weekend, definitely check out Sunday Candy. Have a great weekend, and keep an eye on how easy it is to squeeze your groceries.